Hi everyone, welcome to this series on options. So in this series, we are trying to go through the basics of options so that any beginners who want to learn about options, they can go through these videos and get a sense of what options are all about and how to get started with trading in options, right? So in this first lecture, I'm going to talk about some of the basic things. For example, what is a derivative contract? We'll briefly talk about the concept of call option, put option, how to select options based on your view, when to go long, when to go short on both calls and puts. Then we'll also break down the value of an option into intrinsic value and time value. So what's the difference and how do you calculate this thing? Then we'll briefly talk about the concept of in the money, out of the money, and at the money options. All right. So let's get started. So first of all, what is an option? An option is this is the textbook definition that you will get everywhere. So what we're going to do is we're going to break this down into segments, right? So first, to understand this entire statement, we need to understand what is a derivative. What is meant by derivative, right? We say an option is a derivative contract, but what's a derivative in that? So derivative is something which is derived from a underlying, right? So for example, in this case, milk being the underlying and curd being the derivative. So curd can be derived from milk, right? So you do some processing and with the milk you are able to get the curd, right? So that is the relation of underlying and derivative, and they are very closely bound in certain characteristics. For example, if the price of milk goes up, the price of curd will also go up, correct? So similarly, the prices of curd are derived from and or are dependent on the prices of milk, correct? So similarly, in the stock market, you might have a stock, let's say for example Tata Motors, which is, let's say, trading at 400, and then you have Tata Motors futures as well, right? So Tata Motor futures is a derivative whose underlying is Tata Motors, right? So price of the futures will depend on the movement of the price of the underlying as well. Okay. The second piece that we need to understand in this is what is a contract, right? So a contract is basically as the name suggests, it's a kind of a deal between the buyer and the seller. And for now, you need to understand that there's something called a strike price, and there's a expiry date for a contract, right? We'll get into this the contract bit with an example in some detail. We'll get into it with an example. So hold on for that, but just understand that a contract is a deal between the buyer and the seller, and there are certain components to it. So two important aspects are, one is the strike price, the other one is the expiry date. So now let's take an example of a home, and home is owned by the seller obviously, and there's a buyer who's interested, right? So in this case, what happens is the buyer goes to the owner and says that I want to buy this. What is the price that you are offering, right? So let's say the owner says that I am going to offer you 1 CR for this property, correct? Now the buyer needs some time to think. He does not know what is the actual market value, whether this is high or low, how good the deal is. So obviously he wants to consult various people and then go ahead with the deal. But the seller says that so if you want me to hold it for you, you have to pay some premium, right? So let's say he asks for a premium of 50,000, that you give me a deposit of 50,000, not deposit, but a premium of 50,000, right? And then let's say by this date, 29/6/2021, I'll sell it to you at 1 CR. So you have to decide by this date. Let's say the current date is 01 6 and 2021. So this is the current date. This is now basically when the deal is happening, and this is the expiry date. So the offer is valid only till this date. After this, the buyer will have to go back to the seller and get a new offer. Then it will not be available at 1 CR. It might be available at a higher price as well, right? So, and to get this deal, he has to pay a premium of 50,000. Okay. So in a way, if you think about the deal that has happened, this is like a contract, right? Wherein the premium is 50,000, expiry date is 29/6/2021, and the strike price is 1 CR. So the strike price is 1 CR. Okay. So now what will the buyer do? Let's think from a buyer's perspective. Now he has a total of 1 month to decide, right? He knows that he can get this property for 1 CR and plus the premium that he's paid, which is non-refundable, which is 50k, right? So he can get this property at 1,50,000 on any time, any date before the expiry date. So the buyer will go around, talk to various people. Let's say if someone says that no, it's a good property, you can, I mean, the person says that I'm also willing to buy it at 1.2 CR, for example. That is 1 crore, 1.02 CR, which is 1 crore 2 lakh rupees, right? So then he understands that the price that the seller is quoting is reasonable. He's getting it at 1 crore 50,000, right? Someone says that I can pay 1.1 CR as well, I would pay. So then again, this is a deal that he would want to go ahead with. But on the other hand side, what if he talks to multiple people and they say that the worth is only 90 lakh, somewhere between 90 lakh to 95 lakh, let's say. So then it's not the kind of deal that he would want to go through. So he will incur a loss of only 50,000, right? So the premium that he's paid, which is non-refundable, it will go away. So that will be his loss, but he has that option to not go ahead with the deal, right? So he has, so that's why it's also called an option contract, because you have this option to either go ahead with the deal, or you can also say that, okay, I forego the premium and I'm not going to buy it at this particular price, right? So I hope you understand what are the various elements involved, and this will also help you to kind of understand the definition. Now we'll go through what is an option definition once more. So an option is a derivative contract that gives the holder of the instrument the right but not the obligation. So here, this is the important point. They have the right to buy. So in this case, the person has the right to buy the house, but there is no obligation. So it's not compulsory that he has to pay 1 CR by the expiry. So there's no obligation to buy or sell an underlying asset at a fixed price on or before the predetermined date. So in this case, the underlying asset is this house, and the derivative contract is the deal that has happened between the buyer and seller, and the predetermined date is basically your expiry date. Right. So I hope this concept is clear. This definition is clear. Now, what's a call option? A call option is an option that gives the buyer a right, but not an obligation to buy the underlying asset at a certain fixed price on or before a predetermined date. So, same thing that we discussed. So, in this case, basically the contract, the type of contract that is happening between the buyer and the seller is a kind of, you can call it a call option, right? Where the buyer is saying that I'm giving a premium of 50k to buy this particular property, and the strike price here is 1 CR. And similarly, the other important point is the option seller is then responsible for delivery of those underlying assets at a certain fixed price. Right. So one point in the contract is that the seller can never back out. Right. So he has the obligation and he has the responsibility to fulfill the deal if buyer is willing to buy, but buyer does not have any obligation, right? And same thing for the put option. So in case of put option, gives the buyer the right but not the obligation to sell the underlying asset, right? So the deal could happen the other way as well. Instead of seller giving an offer to the buyer, buyer can also give an offer to the seller, right? And so it will be an opposite. It will be like a put option there. Okay. All right. Then moving on. So now, what kind of view, what kind of position we should take? So let's briefly discuss that. So basically, if you are a buyer of a call option, then it means that you are long call. So buying also means going long. So buyer of a call option is long call, and ideally they would want the prices to go up. Only then they would want to be the buyer, right? So they're bullish. So the view in this case is on the upside. So they want the prices to go up. Buyer of the put option on the other hand side has a bearish view. They would want the prices to go down. So their view is that the prices are headed downwards. Similarly, seller of a call option is again, their view is that the prices will come down. So their view is bearish, right? Similarly, seller of a put option, the view is bullish, right? So just keep this in mind. This is very trivial thing, right? So it has a lot of practical application as well. So for example, let's say Bank Nifty is presently trading at around 40,000, let's say. So this is the Bank Nifty spot, right? And if you feel that markets are going to go up, then you have two options. If you feel that you have a view that, okay, some good news that is going to come in, or the markets are looking very, very good in the medium to long term, then you say that I expect, my view is that it will go up to 42,000. So there will be a 5% increase, let's say in a period of 3 months. This is your view, right? So for this view, what is the kind of position you can create? You can buy option, which has a 3-month expiry, right? Because your time horizon in your view is 3 months. Or you can buy call option. So I forgot to put call option here, right? Or you can sell put option, right? Because as the market goes up, the value of the put will go down. As the market goes up, the value of the call will go up, right? There are various components to it. It is not a one-on-one linear relationship. So we'll get into that, how the option pricing is affected by the movement in the markets. But for now, the basic thing that you need to understand is, if you are bullish, you either buy call options or sell put options. If you are bearish, you either buy put options or sell call options. All right. All right. So let's talk about how are the option prices made. So here on your screen, you see basically option chain, right? This is Nifty option chain. You can go to the NSE website to check this out. The numbers highlighted in blue in this rectangle, these are the strikes, okay, and these are the premiums. So on your left hand side, this is all calls. On the right hand side, it's all puts. These are the various strikes, and these are the premiums of those strikes, right? The spot right now, for example, is trading at, we can assume is trading at 15,683. Now here we need to understand what is OTM, ITM and ATM, right? So first let's understand what is ATM, which is at the money option. So ATM, the full form is at the money, right? So basically we are trading at 15,683. If we round it off, we come to 15,700. 700, right? So the strike which is nearest to the spot is called the ATM strike, which means at the money, right? And then from at the money, whatever has an intrinsic value, so then we'll come to what is ITM and OTM. We'll come to that, but before that we need to understand the concept of intrinsic value. Okay, so what's intrinsic value? So let's pick up this strike 15,600. Okay, so in this case the value of call 15,600 call, the value is 175 value, or let's call it the premium, right? This keeps changing every second, but at this particular time this is the premium, right? Now the formula for calculating the intrinsic value is the spot price minus the strike price. So what is the intrinsic value in this case? The spot value is 15,683 minus the strike price, this is 15,600. So the intrinsic value comes out to 83. So this is the intrinsic value. And then the time value is the difference between the premium, the option price, and the intrinsic value. So if I have to calculate the time value, it will be time value will be equal to 175 minus 83. All right. So this will be 100 around 9. It will be 92. Correct. So we can break the option price into two parts. If in case we calculate spot price minus strike price and it comes out to be negative, right, then we do not, the intrinsic value cannot be negative. We'll have to take it as 0. It cannot be negative. Okay. So in this particular case, 15,600 call has a intrinsic total premium of 175. Out of that 175, 83 is the intrinsic value, 92 is the time value. So now let's look at 15,800 call. Okay, so 15,800 call, let me put it here. The total premium is 63. Now the intrinsic value we know is equal to spot price 15,683 minus the strike price 15,800. So this is coming out to be negative. So since it's negative, we'll take it as 0. So in this case, the intrinsic value is 0 and the entire value or entire premium is only the time value. So in this case, intrinsic value is equal to 0 and time value is equal to 63. Right? I hope this is clear. How we are calculating the intrinsic value and the time value. Now let's also look at how to calculate intrinsic and time value on the put side. Okay. So in case of put side, now we're talking about 15,800 put, right? So 15,800 put, the total premium is 134 and the intrinsic value, as the formula suggests, will be the strike price minus spot price. So it is 15,800 minus 15,683. How much is this? This is 117, right? Yes. So which means this is the intrinsic value, and then the time value will be 134 minus 17, which is 17. Okay. So this is how you calculate for the put side. So if I have to calculate for 15,550 put, so strike price minus spot, it will be negative. So intrinsic value is equal to, in this case, 15,550 put is equal to 0. So whatever is there is the time value. So the total option premium is equal to the time value only, right? Pretty simple, right, to understand. Now, now we can also quickly understand what is. So we know what is ATM, at the money. So whichever strike is nearest to the spot, that is called the at the money strike. So in this case, 15,700 is the at the money strike. Now, wherever the intrinsic value is 0, if intrinsic value is equal to 0, then the strike is called OTM. And if its IV is not equal to 0, it will be either ATM or ITM, right? So ATM might have, like in this case, if you look at 15,700 call, so on the call side there is no intrinsic value, but on the put side you have some intrinsic value, right? Because the spot is trading below 15,700. But so if intrinsic value is not equal to 0, we'll consider that as it will be either ATM or ITM, right? So in this case, if I look at the call side, all these are in the money. All these are ITM. Then this one is ATM, and all the ones below this are OTM strikes. All right. If I look at the put side, this is obviously the ATM for put as well. All of these are OTMs, and all of these are in the money ITMs, right? I hope this concept is clear. What I would request you to do is go through the options chain on the NSE website. Look at it for 5-10 minutes. You'll understand how the prices are moving. What are the strikes? I mean, what happens if spot moves by 100 points? Your ATM strike will change, right? Some will become OTM, some will become ITM. So just observe the option chain from time to time, and you'll get a hang of this concept. All right. So that's it for the first lecture. I'll see you guys in the second lecture. Till then, take care.